Hello everyone, welcome to my YouTube channel Indian Bull vs Bear. In today's video, I will share my analysis of the historical trends of bearing sector. This video is part of the series The Final Missing Piece. Before moving on, please read the entire disclaimer carefully. The bearing sector in Indian share market comprises of companies that manufacture components used to reduce friction between moving parts in machinery. Bearings are essential in automobiles, railways, industrial machinery, electric motors, wind turbines, and aerospace. The sector is a key component of India's manufacturing and mobility ecosystem. The key growth drivers of this sector includes growth in the domestic automotive industry, especially in two-wheelers, passenger cars, and commercial vehicles, push for industrial automation and expansion of manufacturing capacities, railway modernization and metro expansion, increased focus on renewable energy, especially wind turbines, replacement market demand, and export opportunities. The government supports the sector with policies like PLI schemes for auto components, Make in India and Atmanirbhar Bharat initiatives, increased infrastructure spending in railways, metros, and road, indirectly boosting demand, import duty revisions, and incentives for MSMEs. The major challenges for this sector includes raw material price volatility, dependence on imports for advanced technologies and machinery, intense competition from global players and unrecognized manufacturers, high capital investment in precision engineering and R&D, and cyclicality in key end user sectors like automotive and industrial machinery. So now, in order to identify trends in this sector, I will present two graphs. They are the end result of my analysis of the share price movements of last 10 years of top 10 companies of this sector. The top 10 companies of this sector comprises of 2 large cap, 1 mid cap and 7 small cap companies. The first graph will show the yearly returns, whereas the second graph will show the monthly returns. Let's start with the first graph, which is the yearly returns graph. So in this graph, the green bars over here shows the positive yearly returns. The red bar shows negative yearly returns. The orange line at the bottom shows the cumulative returns. The green line shows number of months with positive returns and the red line shows number of months with negative returns. So let's start with 2015. 2015 was a decent year for the sector, and the sector managed to give returns of 29.30% in that year, with 7 positive months and 5 negative months. 2016 was more of a dull year for the sector with only 8.66% returns, 7 positive months and 5 negative months. But in 2017, this sector actually skyrocketed and gave returns of 93.46% with 10 out of 12 months giving positive returns and only 2 months giving negative returns. In 2018, the sector performed like an average sector with 20.18% returns with 7 positive months and 3 negative months. In 2019, the sector actually gave negative returns of minus 15.31% with 6 positive months and 6 negative months. In 2020, again, the sector returned average returns of 18.87% with 7 negative months and 5 positive months. So, back to back, three uh, dull years for the sector, which is followed by 2021, which proved to be the best year for the sector in the last 10 years. And in 2021, this sector managed to give returns of 114.75% with 11 positive months and only one negative month. 2022 was a very good year for this sector, and the sector managed to give returns of 45.06% with 11 positive months and only one negative month. 2023 was even better than 2022 with 49.55% returns, 8 positive months and 2 and 4 negative months. But 2024 was a bad year for the sector, and the sector managed to give negative returns of minus 8.62% in that year, with 8 negative months and only 4 positive months. So, if we want to check the cumulative returns, we'll follow this orange line and we can see that the cumulative returns over the last 10 years is around 1300 percent, which is around 14x in last 10 years. So not a bad number as such in last 10 years. Let's see the key takeaways. So the key takeaways is the first is the cumulative return. We have just seen it 1299.85%, which is approximately 14x in last 10 years. CAGR of 30.20, so not a bad CAGR. Any number greater than 30 is a good number in CAGR. So 30.20 is a good CAGR. Net negative yearly returns only two times. This two is a good number. Best year was 2021 with 114.75% returns. Very good year for this sector. In fact, apart from 2014, the previous 3 years, 21, 22, and 23, were extremely good for this sector. Worst year was 2019 with minus 15.31% returns. And positive to negative year ratio is 4 is to 1, so which is a good number to have for any sector. So overall, an impressive yearly returns graph. Let's move on to the monthly returns graph and let's see how it looks like. So here it is. The green bars here shows the positive mean monthly returns. The red bar shows the negative mean monthly returns. The green line shows number of years with positive returns, whereas the red line shows number of years with negative returns. For January, the average monthly returns are negligible 0.45% with 6 positive years and 4 negative years. February is clearly the worst month for this sector with minus 1.80 average monthly returns, 6 negative years and 4 positive years. March, an average month with 2.07% average monthly returns, 7 positive years and 3 negative years. April seems to be a better month for the sector with 4.95% monthly return, average monthly return, with 9 out of 10 years this sector gave positive returns in the month of April, and only once it gave negative returns. May, a flat month with 6 positive years and 4 negative years. June is by far the best month for the sector with 9.10% average monthly return with 9 positive years and only 1 negative year. July, another average month with 2.65% average returns, 6 positive years and 4 negative years. August, a flat month with 0.81% average returns and 5 positive years and 5 negative years. September, October too can be considered as flat months with average monthly returns of 1.15% and 0.96% only, and 6 positive years in September and 5 in October. November, though, seems to be a very good month for the sector, and the sector managed to give monthly average returns of 5.99% with 6 positive years and 4 negative years. December, again another above average month with 4.05% average monthly return, 7 positive years and 3 negative years. So, I mean, I was very impressed by the yearly returns chart, but not so much with this monthly returns chart. See, there are two. There are sorry, there are two negative average months, February and May, and 1, 2, 3, and 4 months with almost flat returns. 2 months with average returns, and there are actually only 4 months, 1, 2, 3, and 4, which gives some kind of meaningful returns to its investors. Let's see the key takeaways anyways. Cheaper months, February and May. So February and May, 2 months with negative average monthly returns. We can include January, August, October as well in those months. Costlier months are April, June, and November. So April 4.95, June with 9.10, the best month of all, and November with 5.99% returns. And finally, the positive to negative month ratio is 1.73 is to 1. So this is good. This is good. This means against every one negative month in the last 10 years, that is 120 months, there were 1.73 positive months for this sector. So this is a good number. All in all, quite defensive sector, low volatility, somewhat consistent. See, if you just leave February and hold this sector for the rest of the month, you are going to get decent returns without actually worrying too much about getting the negative monthly returns. So in that way, it's a stable, less risky, defensive sort of sector. Anyways, that is all from my side in this video. Thanks for watching this video. If you've liked it, click the like button, subscribe to the channel. Let me know how do you like this kind of content in the comments box, and share it this with your family and friends. I'll be back soon with another video. Goodbye for now.